Hello, everyone. I hope you guys are having an awesome week. I'm here to keep you up to date with current market news and teachings. This is in no way, shape, or form financial or investment advice. This is for entertainment and educational purposes only. So I'll go ahead and jump right into it. So basically, let me just swap over here. Kind of got a lot going on over here. So this came out recently, Friday, February 24th, and it's core PCE price index month over month is basically just the prices of everything except food and energy are going up. And that's a bad thing because that means that inflation can be sticky. Why? Because commodities such as energy are very volatile, right? The prices could go crazy just because of a war and so forth. But when the prices of everything else is rising, it means that inflation is potentially sticking around. So basically, what that means is this. So core PCE prices in the US, which exclude food and energy, because food and energy are very volatile, right? War can occur, for example, such as it did in Ukraine, and Ukraine being one of the largest suppliers of wheat in the world, prices of wheat went ballistic for a certain period of time. So it just goes to show you that these two commodities are very volatile. So this measurement or whatever you want to call it has been spiking up consistently. So the annual rate, the Federal Reserve preferred gauge to measure inflation rose by 4.7% and surpassed market expectations of 4.3%, backing signals from Fed policymakers that interest rates must be higher for longer to tame price growth. So basically, this is one of the measurements the Federal Reserve watches to kind of give them an idea whether to continue with rate hikes or not. So this is basically leading to like a indicator that says, hey, Federal Reserve is most likely going to continue with their rate hikes, or they're going to have to keep them high for pretty long while this thing keeps going up, because ideally they want this to go down, right? So yeah, basically with that, the Federal Reserve board members seem to still have a hawkish point of view. Hawkish meaning they're leaning more towards rate hikes or more rate hikes. So basically, the next Federal Reserve meeting, which is, I believe, well, it is in March. The Federal Reserve is advising they're going to basically increase rates by another 25 basis points, which is a 0.25%. But then there's also speculation that they might do a little more based off of all these indicators that are coming out, right? So yeah, basically, March and May hikes appear very likely, and the Fed might have to hike further if inflation, job growth, and consumer demand refuses to soften. Basically, they want to see that indicator coming down, which is this one here, the core PCE price index. They want this thing to be coming down, and also they want unemployment rates to go up. That's basically something they're saying. That's a way of them fighting inflation, right? Less people are earning salaries and so forth. Less people are buying things, and less demand for things, prices come down, right? So I'll skip this one. This is something crazy I've been looking at. So credit is crazy, like loans, credit loans, and all these kind of things. So credit debt is basically crazy, like increase over like since 2010. This thing's gone ballistic. And I'm just curious if this is potentially eventually going to lead to the end of a credit cycle. The end of credit cycles are pretty ugly things because they're usually the cause of like depressions and so forth. Every time there's been a end of a big credit cycle, typically that's not a good thing for the market. So something to kind of keep an eye out, although this thing just continues going higher and higher. I have no clue how high this thing can possibly go before it goes the other way around, but you can kind of see this massive shot here in 2010. And from here on, the market just continued going up. And when I mean the market, the stock market during this period basically continued to go up massively. And then you kind of see here the COVID credit kind of went down and then boom, back up again. Basically on the low rates, a lot of borrowing and so forth. Delinquencies such as credit card loans and so forth are still pretty low overall compared to the past. But all these things are kind of lagging indicators. They don't really tell you what's going on now or in the near term. So yeah, that's some stuff I kind of wanted to point out. And then on another note, I kind of want to go into what is called the TED spread, which is kind of like a strategy, a known strategy. The TED spread, which consists of treasury bill futures on one side and euro dollar futures on the other. The TED spread has a carrying cost, meaning it costs to hold the spread. When rates are low, the carrying costs are small. It would be larger if short-term rates rose. So basically, this you have to pay to hold these futures due to carrying costs. The TED spread is a lagging economic indicator. That's kind of like why I want to point it out. And the TED spread as a strategy is extremely dangerously risky. So yeah, not something I would play around with. I just use it like a indicator kind of thing. So what is the TED spread? Kind of give a quick definition of it. So the TED spread measures the difference between rates on 3-month US Treasury bills and the 3-month London interbank offer rate, which is kind of give you a definition of that one. So the London interbank offer rate represents the interest rate that banks used when loaning money to one another. The U.S. Central Bank, the Federal Reserve, asked banks to stop using LIBOR as a benchmark as of December 31st, 2021. The Secured Overnight Fund Rates, SOFR, may be the rate that ultimately replaces their LIBOR. So this rate is being kind of replaced by this secured overnight funding rate in the near future, but it's still, I believe, no, actually, yeah, it's been, so the Federal Reserve has asked banks to stop using it. By how long it would take them to completely stop using it, that's unknown. That might, take some time considering this has been around for a long time. So yeah, that's LIBOR rate. Kind of wanted to go into that because, otherwise, unless you're a bank, how the hell would you know that, right? So while the TED spread is generally around or below 50 points, it can increase significantly during times of economic uncertainty. So this is kind of what I wanted to go into with it, because typically when the TED spread, the spread spikes, it means there's some sort of like panic in the overall global market. So investors can look at the TED spread as a measure of risk and volatility in the market, but should not rely on it for their investment decisions. So this is a lagging indicator because typically the Federal Reserve publishes the TED spread 1 week after the fact. So you may not have the most up-to-date rates to fuel any investment decision. So this is not up to par with what things are doing in the market. This is lagging, a lagging indicator. So I like to watch the TED spread. Why? Because when this thing spikes, it's like something's about to hit the fan at some point. And then it's been low. It's been low overall. So I'm just curious. With all this quietness, but yet the market did like pretty bad last year. You would think this would have spiked. So it's just interesting. But then again, this is more of like a lagging indicator. But you can see here basically every time this thing spikes, there's some sort of real big panic in the market. So that's very interesting to see. And let me just swap over here, kind of give a general view of what the market is doing. So let me switch. So the market overall been continuously volatile, up and down, up and down, up and down. So this is basically the market right here, right? The Russell, NASDAQ, S&P, and Dow Jones. Kind of volatility all over the place lately. And volatility is not a good thing. But it is up from recent times, 15%. That's pretty huge. In such a short period of time like that, just a big bounce up. But I'm curious to see where this is headed. I have no idea whatsoever. So yeah, that's basically what the market is looking like right now. Yeah, with that, I'll leave you with a market quote. The investing public usually does not come into the market in force until after a bull market has pretty much ran its course, and does not get out until late in a bear market. So yeah, that's just some stuff I'm kind of like seeing lately. And yeah, thank you guys for joining me today, watching. I appreciate that, and I hope I shared some valuable information with you. Thanks, and have a awesome week.